Hello friends, Marv Eisen here from Timeless Dollar Trading Academy, and this is my chart as I set it up at 8:30 this morning, Friday, May 23rd. And I set up my trading zone here, support at 58.23 and resistance up at 58.84. And I get that, of course, from my Taylor calculator, okay? And here we go, 58.84 resistance, 58.24 support, 60 points between the support and resistance. So it's a 60-point trading range for the day. Okay, going back to my chart. So I set up my chart, and prices were coming in just at Thursday's close, right over here at 58.57. And of course, I always put my a horizontal line on my chart along with the Taylor calculated trading zone. I always put the previous day's close on the chart because, as I've said so many times, that is equilibrium. Equilibrium being a point where buyers and sellers at the end of the day agree there is value at that price. Value for buyers, fairly priced. Value for sellers, fairly priced. And so this is how my chart's set up. And at 8 o'clock, or just before 8 o'clock, prices were coming in just about at Thursday's close. And then look what happened. Prices dove down. What happened? What happened? There was nothing on the economic calendar that would forecast that kind of thing to happen. And so here, Friday, here's my economic calendar, Market Watch. Kansas City Fed President at 9:35, at 10 a.m. new home sales. Federal Reserve Governor Lisa Cook speaking at 12 p.m. None of these things are going to move the market. So what accounted for this? Well, what accounted for this, and I also look at the morning news, CNBC, I'm looking for what could have caused the price drop. Trump calls for 50% tariff on European Union. Said he's not looking for a deal. Now, there was supposed to be a 90-day freeze or a moratorium. It was 145%, then 30%, then a 90-day moratorium. And we wake up today, 50% tariff on EU, and of course the market reacted in the way that it did. All right, so that's what started out the day. Now, Fridays typically favor the market going to the upside, and particularly on a holiday weekend because traders are in a good mood. They're going to have a long holiday. Monday's no trading, remember, it's Memorial Day. And so prices dove way down, and there's 10 points between each horizontal line on this chart. So where were prices going to trade? It was a bust of a day, and so we need to stand by, and I'm going to take you through the day, and I'm going to show you again that using a mathematical model to determine where prices are likely to trade is the best way to trade, especially E-minis or micro E-minis. And of course, this applies to other markets as well. I'll go into a history of George Taylor and his trading calculations in some other video, not today. But nevertheless, my trading zone is based on George Taylor's formulas. And that's what I have put together in the Taylor calculator that it's available on my site at timelessdollar.com. Okay, enough of that. Going back to the chart, and let me take you through the day. These are 3-minute candles. And as the day progressed, we're coming into the open of the day. And here, right over here, market is open a little more. Okay, market's open right over here, 9:30. This is the 9:30 candle right here. Market opens right over here. Down here at 57.84. Prices rise up. Volatile in the morning. Remember, the first half hour to hour of the morning is where prices are most volatile. And I suggest you don't trade, particularly in volatile markets, but it's always safe. Remember, you want to be conservative as a trader because the way to make money as a trader is to avoid risk as much as possible. Now, you can't avoid risk in trading, but you can avoid it as much as possible. You can minimize it. And so to do that, you wait until for an hour, a half hour to an hour after the market opens, see where prices put in an intraday or an early intraday low or high, and then where it breaks out from there. And so let's proceed further. I'm going to take you through to about 10:30. Okay, right about here, we're at about 10:30 here, 10:30 right over here. And as we can see, prices are rising up. They took out the high at 936. The low is in the rearview mirror. Prices are nowhere near. It doesn't mean prices can't collapse further, but it's not looking likely. And of course, remember, the equilibrium area is right over here at 58.57, and the trading zone, the area of likely prices, price action, is up here. And so, is this a good place to take a trade? Yes, it is a good place to take a trade. Why? Again, the previous close is up here, well above where prices are. The trading zone is up here, well above where prices are, and it's a Friday, and it's a holiday weekend. Okay, so we take a trade here at around 5804, 5800. Okay, and so let's continue for the day. All right. Whoops, price is slipping, price is slipping. Is it going to stop us out? And I'll talk to you about stops in a minute. Okay, I'm going to stop it over here. Now, for those of you who've seen my videos, and particularly for those of you who have the Taylor trading zone, you know that the Taylor trading range is more accurate than you could imagine. It's very accurate in terms of the trading range. So what we do is we take our trading zone, and what do? We clone it down to the intraday low or up to the intraday high, and we see where the other end of the day's candle is going to be. So I'm going to take my trading zone, make a clone of it, bring the clone down to the low, in this case the intraday low, which was right over here. Okay. Nope, a little lower than that. Let me bring it down. Yeah, right. There we go. Right over there. Right over here is where the low was put in for the day. And so if the range is accurate, and as I said, the range is particularly accurate, prices should trade up to around here, 58.40, around there. Okay, so let's continue. Okay, here we are, 58.40, 58.40. All right, what happens to prices next? Now, I'm going to stop. Wait a minute. If prices, if you get on at the right place, as I suggested, wait an hour, see where prices break out, get on, transpose the trading zone, you get off at the other end of the range, which was right over here at 58.40. You don't wait to see what happens next. You get off where the mathematical model tells you to get off, all right? And so let me continue throughout the day. Okay? Market is not quite closed. It's only about 4 p.m. Yeah, it just did close. So here it is. Here we are. This is where, when prices hit the 58.40 line, you get off. That's your trade. And again, there are 10 points between each horizontal line. And if you got on at around 58.05, something like that, 58.05, and you wrote it up to 58.40, 35 points gain for the day. Nobody's going to be disappointed with that. Anyway, learn to trade. Learn the 6 trade setup. Psychology is so important. And I did say I'm going to say something about stop losses. Friends, if you can't take a 10-point drawdown, in other words, prices backing off 10 points, you shouldn't be trading. It's not uncommon prices dropping off to try for prices to back off 10 points or more. I mean, look at this. Look how prices rose, and then they back off 10 points, 15 points. But you have to have confidence. If you have confidence, the average of and play the day of week trading. Remember, Mondays, Wednesdays, and Fridays generally favor a more predictable market, not necessarily an up or down market. Mondays and Fridays generally up or down, particularly on a holiday weekend. And so use the Taylor trading zone, use the previous day's close, learn the 6 trade setups, gap, support and resistance, trend, time and price, momentum, and candlestick, and you'll be a much better trader, much more successful trader, and a more consistent trader. And so that's my video for today. I'm going to wish everyone a very happy, healthy Memorial Day weekend. This is Marv Eisen at Timeless Dollar Trading Academy. Thanks so much for watching, and I'll see you in my next video.